Hey, this is Chris from TPLI, and I just wanted to go over a chart of GME, GameStop. I have a friend who went short on July 9th, and I just wanted to go over the chart. Um, Looking at the weekly view, the week before July 9th, you can see that Stochastics is showing that it's in oversold territory. This is a 3-year weekly view, and it is getting stretched out from its 20-week exponential moving average. So the bigger weekly trend is showing that it's in oversold territory already, which means don't want to go short because the chances of GME going up is higher than it is going lower. This is a 6-month daily view of GME, and this is going starting from June 23rd. Okay, zooming in on the 23rd, we had a hammer candlestick pattern. It did have an upper shadow. The upper shadow can be 10% um, or less of the lower shadow. And so by looking at the hammer candlestick, especially on high volume, you can see that the market was it the bears pushed it all the way down right here. It pushed it all the way down to its low. The bears could not hold the lows. Bulls came in, rallied the market up to close near the high of the trading range. This is a bullish reversal candlestick signal, and it's on high volume as well. So the bottom of the hammer, the low, is going to be support based on a close. And the support line that I drew was at $20.40. So now we're going to go, forward more onto the right edge of the chart, and we keep going, and we keep going, we keep going, we keep going, we keep going, go, you know, here. And this is the 8th of July. Notice how the bottom of the hammer is still holding up as support based on a close. The market of GME has not closed under it yet, so that's still strong support. And here's where my friend had entered. Main thing about this is looking at GME, the hammer is still support based on a close. The GME has not closed under it, which means this is still a strong area. It did go down and then it did consolidate right here, a potential bear flag setup. But in order to get a bear flag, you need to close under this support area, which it did not. Also, it was fanned away from the 20-day exponential moving average as well. So entering here, especially with the weekly view showing that it was an oversold and the hammer was still holding up as support, you wouldn't want to enter going short. You wouldn't necessarily want to go long because the overall trend is still down, but you wouldn't want to go short because of these indicators. You would want to wait for a pullback maybe to the 20-day exponential moving average and then go short from there. Going further into the right side of the chart, it did rally up to the 20-day exponential moving average, uh, but then we had a small body candlestick showing indecision, and then right here the bulls are still in charge. The next resistance is right here around 2250, nudging it. If it fails at 2250, you could go short, but your target would be at $20. You could actually nudge the support about 20 bucks. You didn't want to go short on the 9th because you are right at a support area. And that's how a hammer could potentially keep you out of a losing trade. I also wanted to go into the hourly view as well. This is the low of the hammer in the hourly view at $20.40 around here. And you can see that the market right here broke under it, closed under it, which is very bearish, and this is on July 8th. But then a white candle formed. You have a downtrend, small black candle, and then you have a huge white candle. That's a bullish engulf reversal pattern. Bullish reversal pattern. Not only did this white body engulf this small body, but this black body as well. Engulfed two bodies, and the market did rally from there. So the bottom of this on the hourly view is also support as well. And this was made on July 8th. Now you're probably looking at this signal up here. It's a bearish engulfing pattern, and this was made on the 9th. It's a great short. But here's the thing. The high of the bearish engulfing is resistance right here, around 2120. And in order to go short, you need to break under this low. So your entry would have been right here. And your first target would have been at support right here. And you would have been risking to this high. That's not a good risk to reward ratio. So overall, just want to show you how candlesticks are very powerful and they can keep you out of potentially losing trades. I hope this video helps you.